Tell us about what your expectations are for this session, especially when it comes to Chair Powell's speech.
Well, what I would expect him to do is reaffirm his and the FOMC's commitment to the 2% inflation target. And with that reaffirmed, then I think he will talk about leaving rates where they are, but he will watch the data, especially the September CPI numbers, and that will have a big impact on what they will do later in that month. So I think they're going to be focused on making sure inflation gets down to 2%, not 3% as some people would like, and he'll I think, push that theme.
For our viewers across Asia, how concerned are Fed policymakers at this point about the China economic slowdown and whether that could have an impact on where policymaking goes from here?
Well, I think people in the U.S. are aware of what's going on in China and are paying attention to it. And they know that we still have, the U.S. still has a pretty strong economic relationship to them. However, having said that, they are still going to focus on the U.S. situation, which is to bring the inflation numbers down and to focus on that and not get too tied up in the dollar issues and so forth that might be more important relative to the China relationship going forward.
Thomas, you know, we've been talking about the fact that this point in the policy cycle is getting trickier, right? Things are not quite so clear-cut, and you can kind of have arguments for any of the options to hold, you know, to be more aggressive, to lean back a bit more. Are the risks building of a policy mistake, particularly at a time, as Sherry alluded to, where there were growth uncertainties and downside in other major economies?
Of course, when you get to this point, the risk of going too far is greater and not going far enough is greater. And I'll give you an example. One risk is to repeat the 70s, and that is we see this slowdown in inflation, so they back off and inflation reignites. The other is that they push forward, as they did in 2006, further than what might have been necessary, and then you precipitate a sharper downturn. So they're aware of these risks, and that's why I think they're watching very carefully for the data going forward, keeping in mind that they need to get to the 2% inflation target. So they are going to take that as a priority and balance the risk against that 2% target. And right now, inflation is above, well above 3% on the core, just above 3%. So they have a ways to go. So I think their margin of error is to be concerned about inflation not coming down to the 2% target. And that's what they're going to think about going forward. I don't know that for a fact, but that's how I would think about it.
Is there a margin of error when it comes to this, you know, much spoken about neutral rate, right? Because that's certainly what bond markets are really fixated on at the moment. Chair Powell has said he doesn't really know what that level is. Is this the right thing to be focusing on?
I think so. You know, no one knows what the neutral rate is, but they don't know what the neutral unemployment rate is or anything else for that matter. So they're working through that. But we know that the neutral rate now is higher. Everyone seems to be aware of that, and that we need to keep that in mind as the Federal Reserve calibrates its policy going forward from here. They know they're above the neutral rate most likely because the economy is slowing, but how much so they don't know, and so they're going to, I'd say, carefully go forward and watch, as I said, watch the data and make some judgments through the month of September before they get to that final September meeting.
Tom, what does watching the data and that dependency mean for the Treasury space where we have seen so much volatility as of late?
Well, for the Treasury, that's going to remain volatile. For the Fed, they're looking to see where the inflation numbers come out in the September 13th announcements and how the markets react to that, how much further they have to go, or do they move away from their target of 2%? That's what they're going to watch. In the meantime, because of that and the uncertainty, of course, uncertainty means greater volatility usually, and that's why I think we'll see some greater continued volatility in the bond market. What is going to happen to the yield curve? Question mark. How do I make my decisions according to that? And I can change my mind day to day, given what's going on and given the uncertainty in the market that we see right now.
Tom, how much are you looking at, the stickiness when it comes to the medium to long term for inflation, right? Because we have seen this year some unexpected volatility when it comes to commodities pricing, when it comes to what the energy markets are doing. We know that climate and instability in other ways are yet to play out, potentially looking like the hottest year on record. So how much does that complicate things for policymakers?
I think the kind of the intermediate rate or the intermediate period for the rate is even a bigger question, because the economy seems stronger than what people thought it would be. But I remind people that in many ways, if you look at history, we're still early in this cycle, in this tightening cycle. I know it's a year and a half, but the increasing rate period before the great financial crisis was 2004 to 2006. And then they left it at 5.25 for a year. So we're early in the process, and so that's why I think the Fed's going to leave rates where they are for now, and they're going to keep them there at least through a good part of next year, watching very carefully month to month how those inflation numbers can go forward. And if we see a spike in inflation because of the stronger economy than people expected, and because of the fiscal policies that have been very expansionary in the United States over the last 3 years, that's going to play out in how they determine their next policy choice later through the later part of this year and into next year. So uncertainty, waiting for the data, trying to make decisions in that environment is going to be tough for the Fed and tough for the markets.
Tom, let me wrap up the conversation as we started, focus more a little bit on the international markets and economies, because we have seen now some developing economies starting to cut rates given that their economies have started to slow down. Yeah. When we see this divergence in global central policy making, are there any implications that we're not really thinking of right now?
Well, I think looking at the emerging markets, they are slowing. They're reacting to that. You have new leadership there in many cases, but they'll play that. I don't think that will cause the U.S. to change its policy forward, and that will affect them because we will, I think, stay higher than they might expect. That is higher than the emerging markets might expect, and that's going to affect global events going forward from here. The U.S. will lead that, given its policy position and its circumstances right now with this economy stronger than people expected, but still seeing inflation come down, starting to talk about soft landings. I think it's too early in the game for that kind of talk, to be honest, both here and globally.